Hello, everyone. Jacob Cox here. I'm a manager of internal sales supporting One America Care Solutions. Today, we're going to take a deep dive look into part 2 of efficient long-term care risk coverage for the affluent and explore some of the other unconsidered consequences of self-funding LTC. I attached a copy of the slides on the GoToWebinar control panel that's on your screen, but let us know if you have issues downloading them for whatever reason. I also included these slides from part 1's presentation, which took place on August 7th, and the corresponding white paper. Now, this webinar is being recorded, so if you'd like to come back and view the content again, please reach out to your One America internal sales partner. And if you have questions, send them on over to caresolutionstraining@oneamerica.com, or feel free to enter them in the Q&A section of the panel, and we'll get them answered for you after the webinar. So at this time, I'd like to introduce our guest speaker. We're joined again by David Gresham, who's the analysis manager within our advanced markets team. Dave served in the United States Army in West Germany as a military intelligence analyst, and then went on to law school at Indiana University, where he graduated cum laude. After practicing general civil law in Indiana, Dave joined the One America team in 1992. He provides comprehensive advanced sales support to the field by authoring position papers regarding advanced market concepts, assisting in the development of marketing brochures, and conducting national education seminars for the member companies of One America. And with that, I will pass it off. Dave, thank you for joining us today, and thank you for your service.
Well, thank you so much, Jacob. I'm glad to be here again today. And I think without further ado, we'll pick up where we left off last week. Once again, this is 7 often unconsidered consequences of self-funding long-term care. This white paper I wrote about a year ago, began working on it and finished it because we were getting a lot of questions from reps about how do you deal with the objection that I can self-fund? And when we really started to examine how you deal with that objection, it's more than just 1 or 2 issues. There are many things that come into play when people think about self-funding. And I say self-funding because there is no such thing as self-insuring. Insuring involves the spreading of risk, and when you're paying 100 cents on the dollar over your own money, there's of course no spreading of risk. So people first have to understand that we are talking about self-funding. So last week, one of the things we talked about, or what we talked about rather, were the first 4 of the 7 consequences that we kind of developed as issues that were involved with the self-funding decision. And I mentioned last week that I tended to see 2 types of counsel that work with the older population. And of course, there's some crossover, but you tend to see your elder law, your Medicaid planners, or your legacy planners. And the Medicaid planners are all about getting their clients to qualify for long-term care. I mean, not for long-term care, but qualify for Medicaid. So they're about avoiding the 5-year look-back rule, or planning for that, for maximizing the spousal empowerment amount, for turning countable assets into non-countable assets, and things like that. And if a couple walks in the door and they're worth $2 million, they look at them and say, well, you can self-insure. Now, for all the reasons we talked about last week and what we're going to continue to talk about this week, I feel that that is a real disservice to those clients. Now, the legacy planners are generally more allies, because if they've been working on intergenerational wealth transfer for any number of years, they may very well have had a case that has gone awry because of an extended long-term care event. And so they see the value, because what they have seen and experienced in their lives, they see the value of insuring your long-term risk, and generally are more responsive to understanding all of the issues involved in bringing the clients along in that arena. And the same goes for CPAs as well. So to sum up from last week, we talked about sequence of return risk, tax exposure risk, the loss of step-up in basis, and family business succession plans that may be compromised. All of these are things that you have an adverse effect when you talk about self-funding, because you may need to take money out of a portfolio when the market is down. Anytime you liquidate an asset, you're going to increase your taxes, which starts a cycle of being exposed to even greater taxation. And we talked about that. We talked about if you're liquidating capital gain property, you've lost the ability for your heirs who receive capital gain property that may be highly appreciated. They lose that ability to receive a step up in basis if you had to liquidate it during your life. And then we talked about succession planning, where it may go awry because the parents or one of the parents has an extended long-term care event and they need to liquidate the business before it ever gets into the hands of the next generation. Today, we're going to talk about the three things on the right. You see their possible exposure to filial laws, the fact that trust assets may be inefficiently utilized, and you may be wasting chances to leverage business income if you're not thinking about purchasing long-term care with business funds. So without further ado, let's continue. First thing is filial laws. Now, filial laws create a statutory duty for adult children to financially support parents who cannot monetarily support themselves. And currently, I say 30 states have filial laws. 21 allow civil court actions, 12 impose criminal penalties, and 3 provide both civil and criminal actions. Actually, that number has dropped to 26. Several states within the last 2 years have actually either modified or done away with their filial laws. However, some states have looked into enforcing them. Now, one of the things about the filial laws is before 1960, almost all the states had filial laws. But with the advent of Social Security and Medicare, especially Medicare in the mid-1960s, it was seen as much less of a need to look for payment of care to providers for seniors because the government was picking up a great deal of the slack. And so that's about the time you started to see the filial laws go away. But like I say, today, at least 26 states still have the filial laws on the books. The last bullet comment there, the Pittis case, was a case out of Pennsylvania where a son was ordered to pay $93,000 in a nursing home bill that the mother had incurred. And it was a deal where the mother had gone into a nursing home, couldn't pay. And actually, I believe she was Greek, and at the end of her life, she had actually moved back to Greece and passed away there. And the nursing home was looking for payment. The son had funds, and they went after him in court in Pennsylvania under the Pennsylvania filial law, and they won. So it's something to be considered. Now, for these states that have filial laws, it's good to know that. It's good to know if you are in a state that has one. And actually, I have the list, and if you want the list, just email Jacob at the end of the meeting, or you can do it on the chat or whatever. And what we'll do is we'll send you that list. The filial laws are only going to take effect when you have a situation where the person hasn't qualified for Medicaid. In other words, they've gone into a nursing home, started as a private pay patient, and then for whatever reason could not pay the bill. And now the nursing home is looking for payment. So that is your risk there. But also tied in with your filial laws are the state MERP laws. So MERP stands for Medicaid Estate Recovery Program. All the states have it now. And it's somewhat akin to the filial law in that it's a way for an entity to recover costs for long-term care funds expended that have not been paid privately. And so, for example, most states now will go after the probate property that's left in a decedent's estate if they pay Medicaid claims for that decedent. An example is, let's say somebody has income-producing property, a farm or a rental property or something like that. During life, that rental property or that income-producing property was exempt from being countable as long as they used all the income to cover their medical expenses. Now, if it wasn't enough income to pay all of it, then Medicaid would start to pay. When they pass away, that asset's going to be in their estate, and the state's now going to look to liquidate it to cover the Medicaid claims that they paid. So also be aware of the state MERP laws. It's not, for example, a home with a spouse in it is exempt. I said income producing property is exempt. There are things that are exempt. But the deal is, once the person, the recipient of Medicaid benefits passes away, if there's anything that funnels into the estate, then the state's going to look to recover from that property. So bear those in mind as well. So that's the first one, the state filial laws and the fact that, the government and private companies are going to be looking for recovery of expenses, and we need to be mindful of that. Once again, I think it's a further reason to really think about making your clients aware of long-term care insurance, especially for affluent children of parents who maybe are just above that Medicaid threshold, and who may be in danger of not paying their final nursing home bills. I mentioned before when I began this discussion, I said a lot of the states started doing away with their filial laws in the mid-1960s after the advent of Medicare and Medicaid. Of course, now we know that Medicaid in particular is probably not sustainable as it is, and most likely Medicare. We know Social Security at some point in time is going to go under because of sheer demographics, but currently Medicaid is just crushing state budgets. And so rather than looking to be freely paying out benefits in the Medicaid arena, states are looking for every way they can to recover. And that's only going to be more intense as time goes on. So once again, I think being familiar with these laws will help you in the sale of long-term care insurance and help make your clients aware that there are many reasons they need to consider long-term care insurance. Okay, moving on to the next topic. This is something I call using trust assets efficiently. Every week, if not multiple times a week, I will get a call from either an agent, from a trustee, sometimes even directly from clients, asking whether or not our asset-based long-term care insurance can be held by a trust. And so then that begins the discussion. So the first answer is yes. Our policies are written so that you can have third-party ownership. So a trustee can own. What the language of the policy says that we will pay to the owner or directly to the providers of care at the owner's direction funds for qualified long-term care claims encountered by the insured. So yes, you can have, even though it's a reimbursement policy, you can have third-party ownership, you can have trust ownership. But that is not the end of the analysis. And so that first dashed bullet point there, I say for analysis, we must know the type of trust. Is it revocable, irrevocable, grantor, non-grantor, living testamentary, and what are the dispositive provisions of the trust? So for example, the second comment there, I say the islet that's no longer needed, the irrevocable life insurance trust. Trustee will call and say, clients really feel they don't need this trust anymore. They feel the premium has become too much of a burden. They want to know if there's something else they can do with the policy. Can they exchange that policy for long-term care? And so the answer generally is yes, but once again, that's not the end of the analysis. You need to know what the dispositive provisions of the trust are if you plan on having the funds from the policy go to the long-term care providers if the insured goes on claim. And so you have to look at the trust and say, are there provisions in there for funneling money out to a spouse or to children where they could pay the providers? Are there provisions in the trust where it could terminate? I've had attorneys tell me they were terminating trust because the trust had language in it that said if the purpose of the trust can no longer be served, then the trust may terminate. And they have felt that because the shelter amount for estate taxes has gone so high now, it's over $23 million per couple, that if a couple has $5, $6, $7 million in their estate, that they don't have a risk anymore. And so the purpose of having the trust for estate liquidity is no longer served, and they feel they can terminate the trust. If they terminate it, then what do you do with the funds? Generally, it's going to go to adult children beneficiaries of the insureds, And if they agree to go out and buy long-term care insurance on mom and dad, then that's what they do. All these cases tend to be somewhat fact specific. So if you run into a trust case, feel free to give us a call, because once again, we have to talk through all these issues. One technique we see is that if there are no really good provisions in the trust for funneling money out, if the trust has general trust provisions to transact with the grantor with as far as loans are concerned, then you can do that. And what happens is the trust will make a claim for the benefits, will pay the trust. So those funds for the long-term care benefits will go into the trust, and the trust will now have cash. It'll collect all that cash and then make a loan to the grantor, who then has the proceeds to go out and pay the providers. That loan will be an asset of the trust, and generally they write it so it's not due until the person dies. So not only is the principal part of the trust, but the interest as well. And so you actually even get more leverage through the transfer tax system and through probate by doing it that way. Generally, the recommendation is that the client, the grantor of the trust, have something that they can legitimately collateralize, and that the trust isn't, the note is an arm's length note. So anyway, there's a number of ways, if you will, to skin the cat. Every now and then it's just not workable, but in many cases it is. I'll say one word about revocable trusts. And this is my philosophy in general about asset-based long-term care. My feeling is that these policies are always best if they're personally owned. Anytime you start dealing with a third party, now for the whole claims process, you've got to go through the trustee or the third party owner, and you've got another layer of transaction that you have to go through at a time when transactions sometimes aren't easy because maybe the competence of the insured has been lost and things like that. So I always believe, personally owned, and if you're worried about competence, then you can have, a durable power of attorney for someone to handle the policy and things like that. The reason I say that with trust ownership and revocable trust is that if these policies pay a life insurance death benefit, that is already a non-probate transaction. The death benefit is going to pay to a named beneficiary outside of probate. So there's no probate reason to have these policies in a revocable trust. Now, if you want to make a trust the beneficiary of the death proceeds, because you have a spendthrift child or minor beneficiaries or something like that, that's fine. You can make a trust the beneficiary of the death proceeds, but have individual personal ownership. So once again, in the case of a revocable trust, I recommend you revoke the funds out of the trust for the long-term care insurance and just have it personally owned. Now, it's not that you can't have it in trust, but once again, I'm always a fan, and it may sound crazy as an advanced sales attorney in the insurance business, it may sound crazy, but I am a big fan of not reinventing the wheel if you don't have to. I'm always for using the simplest technique that accomplishes the client's goal. And I think a lot of time personal ownership with either a trust beneficiary or personal ownership with a durable power and a trust beneficiary are better ways to go than dealing with a trust. Though once again, you can deal with a trust. Now, this last bullet comment here, the complex trust seeking to reduce tax exposure, we sold a number of policies in this venue. And this is an example of how it works. Let's say husband and wife both have wills that provide that when the first spouse dies, money goes into trust for the kids, maybe up to a certain amount or up to the estate tax shelter amount, and the remainder goes to the wife in trust to pay the wife's income if she needs it, and then at the wife's death, the remainder goes to the children. Not an uncommon estate plan, especially it was not an uncommon estate plan before 2010, when your shelter amounts were below 3.5 million and lower. For years up until 2000, it was just $600,000, and you saw that type of planning a lot. So we do see situations where, let's say for example, a husband has died, money has gone into trust for surviving wife, remainder of the kids at the wife's death, and the wife says to the trustee, I don't need the money. I have my own pension, my own Social Security. The house is paid for, so just let the funds build up in this trust and give it to the kids when I die. And that's very noble and very good and fine and not a bad idea. But the trustee then shrieks because the trustee knows that trusts, when they are taxed on their income without doling it out to beneficiaries, are in a very high tax bracket. The trust tax brackets are compressed. You're in a 40.8% tax bracket after $12,950 of income. And that's just federal. If you're in a state like California, that the maximum bracket is like 13%, you could very well lose over half of your income to taxes every year on trust held assets. And so trustees, if they're in that situation where they're not distributing funds and they have to pay taxes on the income of trust, are looking for a way to reduce trust taxation. Well, in that situation, if your spouse is insurable, I would say consider asset-based long-term care, because perhaps the only real concern the wife has about ever needing the trust money is if the wife goes into a nursing home, if she has an extended long-term care event. Otherwise, she feels she's never going to need it. And you know that the trust has provisions for paying to her because that's the way it was drafted. And so if the trustee goes out and buys asset-based long-term care, you've solved everybody's problem. If the wife needs long-term care, you've got tax-free long-term care money coming out of the trust for the wife. The trustee's concerns about taxes are taken away because, as your policy grows inside the trust, it's life insurance, they're not taxed and the benefits come out income tax-free. And if the wife never goes on claim, then the kids get the tax-free death benefit from the trust. And so that's why I call it a triple win there. You reduce the tax exposure, you have long-term care coverage for the income beneficiary, and you have tax-free death benefit for the remainder beneficiaries. So once again, if you run into these situations with the trust, feel free to give us a call. We're always going to ask questions about why do they want to do this? Why, in the ILET setting, why do they want to exchange? Sometimes I think trustees and insureds and agents who work with them are too quick to do away with a good, healthy policy and trust, because remember, those policies are still going to pay a death benefit. The kids are going to get a whole lot of tax-free money at the parents' deaths, regardless of the existence or non-existence of estate taxes to the estate. And so, I want us to sell long-term care, and I like us to sell it in trust, but I want us to do it when it's appropriate in the situation. So that's all I'll say on that. Now we'll move on to, I went the wrong way, didn't I? Now we're going to move on to the business setting. And this is where, as an advanced salesperson, I get the bulk of my questions regarding asset care. And I think the reason is because the One America Care Solutions product line is the only, well, it's not the only one now, but it is the best product at identifying out the long-term care charges in the hybrid product. So what I mean by that is we separate out the acceleration of benefits charge on the base policy, and if you buy continuation of benefits coverage, we identify that out too. And you know what those charges are, and you can single pay them, you can 10 pay them, you can full pay them, but you know what that charge is, and that charge is pure long-term care insurance. As to the base policy, which is life insurance. And so what you have to understand is that you've got one product with a hybrid product, but you've got two issues. And that's the tax treatment of the base policy versus the tax treatment of the long-term care charges. The base policy is treated like life insurance. And so let's say you've got a situation where the employer is paying a premium on the policy that an employee owns. There's a standard 162 bonus. The employer deducts it as compensation paid, and the employee reports it as income as compensation received. So let's say client walks in and says, I have got 6 shops around town. Each shop has 15 employees, and each shop has a manager, and they're key to my operation. And I want to do something just for the managers. So now you know you're thrown outside the qualified plan arena because you want to discriminate. They may very well not want to have to deal with deferred comp because the new deferred comp rules after Enron, when Congress enacted new rules for deferred comp, it's cumbersome now to install a deferred comp plan as it is to install a 401k plan. And so a lot of small employers simply aren't interested in that. Ford Motor Company is still doing deferred comp, but your small employers aren't interested. But they still have these situations where we want to cover just one guy out of a group of people. So there are kind of two things that we generally see happen. They either bonus them or they do split dollar plans with a separate rollout. I see more bonus plans than anything else, and I see this in particular with asset-based long-term care. So the situation is we have one guy, it's a top hat plan, we have the employer paying the premium on a policy that the employee owns. And in this case, it happens to be hybrid long-term care. The base policy, once again, treated as life insurance, taxable like the standard 162 plan. But the long-term care charges are treated as employer-provided medical coverage. And if you have a non-owning employee or the owner-employee of a C corporation, it's not reported in the employee's income, and there's no limitation on that because it is employer-provided medical coverage. And so it's a great way for an employer to say to a non-owning key employee, here's an additional benefit for you, a top hat benefit, only half of which you have to include in income. Because when you buy, for example, a full life policy, and especially if you buy inflation or if it's a joint policy, those long-term care charges will be as much, if not more, than the base policy. So it's a great way to provide an additional benefit without having the income tax consequence to the employee recipient of the benefit. And for C corporation owner employees, it's a great way to get retained earnings in the C corp out as a benefit for themselves without having it be taxed. Now let's talk about some of the issues that come up. And I'll approach this the way you read Hebrew. We'll go from actually right to left. And on these three circles here, we'll start with individuals. And so this is a straight tax deductibility conversation. For individuals, I say to agents, forget about ever discussing the deduction because for most people, it's illusory. And the reason I say that is to be able to deduct your long-term care charges as an individual, first you must itemize. And with the shelter amount or with the standard deduction now being so high, for married, it's over 24,000. There aren't that many people itemizing anymore. I think for tax year 2018, it was only something like 15, 16% of people itemized. So first you have to itemize. Second, your medical expenses have to be above 7.5% of your AGI. Well, for most people, they've had to have something pretty catastrophic happen during the year for them to exceed that. And so even if they itemize, they're probably not going to get the deduction. And then even if they itemize, then they're subject to this age-related cap, the table, that goes 40 and lower, 41 to 50, 51 to 60, with the amounts going up every year. So they do get a deduction, but it's limited by the cap. Now, let's go to the middle where I say flow through owners. Their deduction is limited to the age-related table, but since it's an above the line deduction, they don't have to itemize and they're not subject to the floor. So it's much better treatment than just trying to do it individual. So when your insured is a pass-through owner, so they're a sole proprietor, or they're a greater than 2% S corporation shareholder, or they're a partner or an LLC member, then they're going to be limited by the age-related table. But especially if they're 61 to 70, that deduction is pretty high. For a couple, it's over $8,000, almost $9,000. That's a pretty healthy deduction. And so I say to reps, if you have a client or clients who are thinking about joint coverage and lifetime benefits especially, and they have a business, think about running the premium through the business, even if it's a pass-through entity, because as they use it as a pass-through payment, they're still going to be guaranteed of getting the age-related table deduction. And the way that happens is it comes through their Schedule C as income or their K1 as income. But on the front of the 1040, there is a downward adjustment to gross income. Before you get to adjusted gross income, there's a downward adjustment for self-employed medical expenses, which includes long-term care premium. And so that's where they get to take that deduction. Then once again to the far left, reading once again right to left, your employees that are non-owning or your C corporation owner employees, that's where the real sizzle is, because there's no limitation on the deduction you can take for the long-term care. And I have seen accountants routinely do a single pay, and you maybe have 100,000 in the long-term care premium, in the COB, and they deduct it. And it's a great way for, once again, C corporation owner employees to get retained earnings out of the C corporation. Now, there is an overall limitation on comp. Section 162 of the Internal Revenue Code says employers can deduct all reasonable necessary compensation. So the question is, what is reasonable? If a person's making $200,000-300,000 a year and you increase it by 100, you're probably going to be fine. If you've got somebody who's maybe making $50,000 a year and you're now thinking about deducting over 100,000 1 year in a stand or in a single loan, a single pay COB premium, there might be a question. In those cases, I think you're fine if you do a 10 pay. But once again, I've seen accounts across the country not bat an eye at taking the deduction in 1 year on a single pay with the COB. So this is the major business sale, and I will tell you that I believe that Care Solutions owns this market in the country currently, because we do a better job. We're one of only 3 carriers that really identifies the charges out like we do. And I think our product is simply the best right now at giving you the best bang for the buck on the way those LTC charges are made. And also, we're the only ones that provide joint coverage and lifetime coverage. And so, it's a marketplace that we really kind of happily own right now. And do a lot of business in that arena. Move on to the next slide here. We do sell policies in other business settings, but it is rare. I would say 95% of the business premium we get for asset-based long-term care is in bonus plans. But we do occasionally see other arrangements. We'll see split dollar arrangements. We'll see key man. We'll see some qualified 401h. At least we get a lot of questions about that. And 412, which is also using a 401h account. So I'll talk briefly about these. A split dollar is life insurance where the employer actually owns the policy, but endorses a death benefit out to the employee. Basically, the employer controls the cash. Really what they control under the current regulations is they have to control the greater of the policy cash value or premiums, cumulative premiums, whichever is greater. There cannot be any equity in the policy in order to the employee. But the employee can have all the death benefit above that. And so, they endorse that over and it pays then to the employee's heirs and it's tax-free. Every now and then we will have a situation where the employer says, I want to control the money. I really do want to provide the benefit, but I want to control the money, at least until the employee retires or until a certain point in time. And I may transfer the policy to them at that point in time, but I want to control it now. And I'm even willing to let them have the death benefit, but I want to control the cash. And so we will see that every now and then. Earlier this year, we had a case. It was a mother, and she was, 75, 80 years old. And she had 2 sons, both of whom were very valuable to the business, but they weren't the best money handlers. And she wanted the business to pay the premium, but she didn't want them controlling the policies. And she said, I want to split dollar it. And I said, well, those split dollar costs are going to go up because the term cost that you have to report every year increases as a person ages. But when we sat down and looked at it, since the policy death benefit is level on our asset-based long-term care, and since your cash is always growing and your cumulative premium is always growing, the pure at-risk amount is always getting smaller, the tax for the reportable benefit on the life insurance every year didn't get that high. And so they were fine with having it be a split dollar, and it'll probably stay a split dollar plan forever. So once again, that was a unique case, but everybody was on the same plan and the clients really seemed to understand it. And so that's what we ended up doing. Key man coverage is also similar to that, in that the employer owns the policy. With key man coverage, the employer is simply also owning the death benefit. So the employer is buying the coverage and saying, if my employee dies before retirement, I've got the death benefit. I'm going to use that as key man coverage to cover my cost in going out and hiring a replacement, standard key man. In those settings, we definitely recommend you have a formal adoption of a 105 plan, which is basically a resolution that says the employer is going to reimburse long-term care expenses if the employee encounters any. So that you have a written 105 resolution, and then you also have a resolution or an agreement with the employee that says when the employee retires, because at that point in time there's no need for key man coverage anymore. When the employees retire, the employee will be bonused the policy. Now they're going to have to pay tax on the cash in that year that they retire, but they know they're going to get the coverage. And so in the key man setting, we will usually see a two-tiered agreement. We'll see the 105 for the long-term care reimbursement while they're working, and then a standalone agreement that says when you hit retirement, we're going to transfer the policy. And we call that basically a Section 83 rollout. And once again, we have sold some like that. The last one there, 401H, is basically, it's an account inside of a qualified plan, generally a DB plan. Well, it has to be a DB plan. And it covers both pre and post-retirement medical expenses to include long-term care. And so you can have medical insurance in there as well as long-term care, and you can pay your long-term care premiums out of it. There are some restrictions. Can't be more than 25% of the overall plan balance going into the 105 account, the 401H account rather. And then there are some questions that are a little murky that the IRS hasn't fully answered, but you basically have to keep the plan open even after the employee retires to pay the benefit. And if the death benefit pays, rather than being a tax-free benefit, since this is a wholly owned pension asset, it's simply that death benefit comes in, becomes part of the pension balance, and then is going to be a taxable benefit out to the heirs of the pension account. I've had a number of third-party administrators across the country call and talk to me about this and say they were writing into their 401H accounts provisions for long-term care. So we'll see what happens. This is obviously a very niche market. You don't see these type of DD plans except for your professionals who are basically the only employees of the business. So it's the consultant or the doctor, the architect, whatever, where they're basically the only employee, the only employee, and they're making, $250,000, $300,000, $400,000, $500,000 a year, and they're willing to go through the annual cost of having that type of plan because they can get such a large deduction. And in this setting, think about it. In this setting, if it's done right, they can, on a non-taxed basis, fully fund their lifetime long-term care risk. So that's a pretty unique opportunity for that unique situation if you encounter it. So once again, that's the end of the last three of the 7 that we've talked about now about the things that you really forget if you think about self-funding your long-term care risk. So once again, we'll recap. Last week, we talked about sequence of return, tax exposure, step-up and basis, family business plans. This week, we've talked about filial laws, effectively using trust assets, and chances to leverage business income. Before you listen to any of these, I imagine there are a great number of you who never even thought about some of them, if not most of them, as reasons to really think about long-term care. I am convinced that there is no better way to efficiently fund your long-term care risk for the affluent than with asset-based long-term care coverage. We sell policies to millionaires every week, every day, most likely. And it's not because they can't self-insure, it's because when they understand all the factors involved as a matter of risk, coverage, and portfolio management, they understand there's simply no better way to cover that risk and with asset-based long-term care. And then they get the benefit of being able to use their other funds more like how they want to use them. It can be liberating for them to have long-term care coverage. And I would maybe say that issue number 8 is long-term care insurance coverage can be liberating. So with that ends the discussion of asset-based long-term care and efficient risk coverage for the affluent. I hope you have enjoyed the presentation and that it's been valuable. And with that, I will return it back to Jacob.
Well, thank you, Dave, and thank you everyone for your time and attention. If you'd like a copy of the slides, the recording, or the white paper, please reach out to your One America internal sales partner, or feel free to email me at caresolutionstraining@oneamerica.com. Now, if you ask questions during the webinar, we'll get them answered for you as soon as possible. Thank you again, everyone. Until next time, be well.